Welcome to The Explainer. Today, we're putting on our financial detective hats to investigate literally the most pressing question in the markets right now. Is this massive AI tech boom the dawn of an entirely new era for humanity? Or are we staring down a historic financial bubble that's just waiting to burst? Let's get right into it. We're going to kick things off with a staggering number, 45%. A recent Bank of America survey asked 172 global fund managers what they considered the absolute biggest risk to markets today. And guess what? A massive 45% of them pointed directly at the AI bubble. In just 1 month, that number jumped significantly. So the smart money? Yeah, they are officially getting nervous.
Part 1. The trillion-dollar question.
To understand why these seasoned investors are sweating, we first have to wrap our heads around the sheer, unprecedented scale of the money involved here. By late 2025, the semiconductor giant NVIDIA reached a market valuation of roughly $5.45 trillion. To put that completely astronomical number into perspective, that single company became worth more than the entire gross domestic product of almost every country on Earth. It actually surpassed the listed stock markets of Germany, France, and the UK combined. And here is where it gets a little scary. Look at the extreme concentration of the market right now. At one point in 2024, just this single company accounted for 34.5% of the total returns in the S&P 500 index. It's like a giant game of Jenga. When a market is this heavily concentrated, if NVIDIA continues to rise, the tower stands and everything looks fine. But if it starts to wobble, the entire broader market is incredibly vulnerable to a severe hit. Section 2. Following the AI money. When valuations get this high, you have to follow the cash flow to see exactly how these incredible numbers are being generated behind the scenes. And this brings us to a highly controversial practice keeping the industry afloat. Critics and analysts call it circular investment, and honestly, it's raising some major red flags in Silicon Valley. So here's the crucial dynamic. The money basically flows in a closed loop. For example, NVIDIA invests a massive $100 billion into a company like OpenAI. Then, OpenAI turns around and uses those exact same funds to buy massive amounts of processing hardware right back from NVIDIA to power their data centers. It's a structure that makes valuations and revenues absolutely skyrocket, but it relies heavily on debt and doesn't necessarily reflect organic, outside consumer demand. This is exactly why famous investor Michael Burry, the guy who famously predicted the 2008 housing crash, is sounding the alarm. He warns that this kind of loop creates what economists call a bezel. The bezel is this temporary psychological blind spot where the money and the assets feel completely, entirely real to everyone involved, right up until the exact moment they suddenly don't. The market genuinely believes the wealth is there, but it's built on a pretty fragile foundation of internal spending. Section 3. The dot-com déjà vu. Let's rewind a bit, because for Wall Street veterans, this is giving them serious déjà vu looking back at the year 2000. During the dot-com bubble, Cisco provided the hardware backbone, the metaphorical picks and shovels for the whole internet boom. The revenue was real, but the assumption that the build-out would just last forever wasn't. When telecom companies stopped buying, Cisco's stock violently crashed by 80%. Barry argues NVIDIA is playing that exact same risky role today, sitting on $119 billion in non-cancelable supply obligations. If the AI build-out slows even a fraction, that becomes a massive liability. JP Morgan's CEO, Jamie Dimon, sums this up perfectly. He points out that, yes, AI is absolutely real and transformative, but history constantly shows us that a technology can fundamentally change the world, just like cars or TVs did, while simultaneously bankrupting its early investors who overextended themselves during the hype phase.
Section 4. The enterprise economics problem.
The core issue threatening to pop this current bubble is what experts at firms like Goldman Sachs call the enterprise economics problem. Take a look at the massive disconnect on this side. You've got C-suite executives buying up AI software, projecting measurable gains in output and productivity. But on the ground, a massive 90% of firms report absolutely zero impact of AI on their current line worker productivity. Zero. Companies are buying these extremely expensive tools out of FOMO, but they just aren't seeing the promised returns on the actual factory or office floor yet. And that lack of immediate corporate payoff becomes frankly terrifying when you look at the financials of the AI builders themselves. You have companies like OpenAI committing to an estimated $1.4 trillion in long-term infrastructure and data center costs. But right now, they're bringing in roughly $13 billion in annual revenue. The gap between what's being spent and what's actually being earned is astronomical. This mismatch creates what supply chain experts call a highly dangerous bullwhip effect. Because everyone is terrified of missing out, tech companies are completely over-ordering chips. But if end-user enterprise demand drops just a tiny bit, because, say, the software isn't actually boosting productivity, that small drop amplifies all the way backward. It could completely devastate the semiconductor companies who are locked into billions of dollars of manufacturing debt. Which brings us to Section 5, the bullish counter-argument. Now, to keep this explainer completely impartial, we have to look at why heavy hitters like Goldman Sachs and the Federal Reserve completely disagree that this is a bubble at all. The bullish argument points out that unlike those highly speculative, cash-poor internet startups of the late 90s, today's AI leaders are highly capitalized mega corporations. Goldman Sachs notes that stock gains are backed by actual, verifiable profit growth. Morgan Stanley points out that top U.S. firms have 3 times more cash flow today than during the dot-com era. Basically, they argue this isn't purely speculation. It's a massive capital expenditure cycle funded by companies that actually have the cold, hard cash to spend. Section 6. 3 scenarios for a crash. Despite those really strong defenses, the market remains heavily on edge. Analysts have mapped out exactly how a potential crash would unfold if the bears are actually right, and it comes down to 3 specific scenarios. First, earnings disappoint. If companies fail to meet those astronomical profit expectations baked into their stock prices, the hype deflates. Second, a demand mismatch. If the supply of expensive AI chips suddenly outpaces actual buyer demand, chip prices crash. And third, innovation simply slows. If new AI models just offer slightly smarter prompts but no major revolutionary breakthroughs, investors will absolutely stop funding those trillion-dollar infrastructure bills. And as this timeline shows, we've already seen how these fears can trigger real-world consequences. The very first cracks formed in late June 2026. A localized panic in South Korea's Kospi index over chip prices rapidly escalated into a global tech sell-off. The Nasdaq sank. Global chip manufacturers booked huge losses over debt fears, and heavy AI investor Oracle dropped 19%, closing its absolute worst week since the dot-com bubble. The market proved exactly how incredibly fast sentiment can turn. So let's bring it all back to you. We've followed the astronomical money, we've examined the fragile infrastructure loops, and we've looked at the striking historical precedents. As these megacorporations spend literally trillions to build our digital tomorrow, you really have to ask yourself, are you looking at the dawn of the future of humanity, or simply the final days of a massive financial bubble waiting to burst? It is the trillion-dollar question, and the answer will undeniably reshape the global economy. Thank you so much for joining this explainer. Keep questioning, keep learning, and I'll see you next time.